Here we go. Let's talk today. I just want to go through a few more, try to briefly go through a few more of the financial statements, the balance sheet. We'll probably get started in income statement and cash flow both. So you guys only got a week or two really to get your financials done, and those are the main ones, right? And then the projected balance sheet we'll talk about next week. We'll only have one day next week though, right? Because Monday's a holiday, so yeah. And then everything, your financial stuff's kind of due the 3rd. So you guys got your work cut out for you outside of the classroom. Okay, so I'll spend a little time today, and then I'll come around and see how you're coming and whatnot, and answer any individual questions you might have for your specific projects, etc. So we went through the startup expenses. The next one, of course, is the balance sheet. Maybe well, I'm going to talk about it a little bit because there's some folks that might listen to it on the recording. I was going to ask if you guys had any questions, and if none, we could kind of skip through it a little bit. But I'll go kind of quick, and for you guys that listening to this on video, if you have questions, maybe get a hold of me. So, anybody have any specific questions about the balance sheet? What we're going to do on that? Remember, most of the information that was on your startup ends up being on your balance sheet as well. Okay, that's kind of the important thing. Not necessarily all of it, but most of it anyhow. Okay, where's your cash and bank come from? How soon we forget.
What you're putting in?
Where on your balance sheet, where do you get that number? Yeah, the cash and bank.
What did you say? Sorry.
On your opening day balance sheet, where do you get the number for your cash in bank?
Your investment.
No. First guess was your investment.
Bank loan. Bank loan.
Bank loan, no.
That's my investment.
Your working capital off of your startup expense sheet, right? It's the working capital number. That becomes your cash, right? It should be linked directly. Inventory is going to come right off of your just whatever inventory you've built up on your startup. And remember, it's perfectly fine. Like if you've got kind of a complicated inventory and you want to set up a separate spreadsheet to kind of list your inventory and what you're doing there, you ought to. And then you could certainly reference that. You could have 10 different categories with one major total, and it's just the total that you need on the startup and the total that you need here on the balance sheet. Okay. Prepaid expenses. What might be our prepaid expenses?
Would that be insurance?
Insurance could be a prepaid expense, certainly. Any others? Rent may be, if your landlord required that, and a part of rent could be, sometimes they require you to make a deposit. Sometimes they even require that you make a deposit in first month's and last month's rent. Okay. If that's the case, then the part that would be a prepaid expense would be the deposit and your last month's rent, because that's going to stay on your balance sheet until you move out, right? Okay, because they hold that for you, and then the last month, of course, they'd apply that last month's rent, and then your deposit you'd get back, presumably, if you leave it in good standing, right? Other could be unique things that you might have for your own business. I don't know. They talk about maybe some intangible things, investments. I don't know. Most of you probably will not have another category under the current anyhow.
So would my training, would that be into kind of prepaid expenses then? Because I'd have to have the training before I could have the business.
Maybe. Okay, I'll come around and we'll talk about that. The question was, would training be considered that way? And that's possible because you could look at training at a couple different ways. You could have it as a straight write-off. It's just a straight expense that really disappears before your opening day because you expend some money, right? Okay, you're going to have some expenses maybe that disappear, right? If you had prepaid salaries, for example, you paid some people up front, and then on opening day, that money's just gone, right? Okay, and your training may fit into that category, but you may want to list it as a prepaid expense and then write it off over the year, just so you're showing it that way. Machinery and equipment, when we get down to fixed assets, again, that should come right from your startup. And once again, if you have a separate spreadsheet for that, wonderful. Some of you may have more complicated machinery and equipment types of things where that would certainly be the case. okay? I think John was building kind of a separate little spreadsheet there maybe, and if you want to put your 20 items over here, but then you just have a total that goes onto your opening day balance sheet and on your start of expenses, that's fine. Go ahead and include, on the tabs down here, go ahead and include that other spreadsheet. The more information, the better, okay, in this case. So everybody knows how to add the tabs, right? Combine them. Okay, if you got questions, I'll answer those as we go around. Furniture and fixtures. What's the difference between that and machinery and equipment? Furniture and fixtures are those, if you're a doctor, there's the chairs and stuff, tables that are out in the waiting room. Okay, fixtures might be also, if you're a retail place, so it might be the pegboards or those types of things that you would have. Counters, things like that, could be fixtures and furniture. Okay, leasehold improvements. If you're going to lease your location, you still might have to have those leasehold improvements. You might have to go in and do those. And those are actually considered an asset. They go on your balance sheet, and you will depreciate those then. When we get talking about depreciation, you will depreciate those. Real estate and buildings, only if you're actually purchasing. Right, only if you're actually purchasing your location would you have real estate and buildings, and for some of you that might be the case. For others, you may not even have a location, right? I don't think John's business is necessarily going to have a location, right? Might, I don't know. Okay. Other assets, again, you might have a patent, you might have a trademark. Probably not. We probably don't have anything like that going on in here, but it's possible. If something doesn't fit up here, we might throw it in there. Okay, got our total assets done. Right? Liabilities, you shouldn't have any accounts payable when you start. Not on your opening day balance sheet anyhow. Okay? That could happen if we go through it. Depends on how you set it up. Depends on how you set up your income statement and your cash flow. But that could happen by the end of the year one when we do your pro forma. For most of you, it might be a little easier if we do this on a cash basis kind of. So you might not do that. Taxes payable, you wouldn't have any of those, right? Notes payable, you shouldn't have any of those on your opening day balance sheet. Maybe except Garrett. Garrett might have something like that just because of he's got kind of a unique business that we're going to take a look at. So current portion of long-term debt, however, we will have, right? Remember what the current portion of long-term debt is? Don't let me down like you did on the working capital.
Amortization schedule or something?
Kind of. It comes from there, yeah. What is it, though? CPLTD is equal to... I thought that I just ingrained that into your noggins in business finance. First
12 months of your principal.
First 12 months of your principal. Garrett at least had notes that he could look at, right? It's the first 12 months, so it's the principal portion of your first 12 months of payments, right? It's the principal portion of the first 12 months of your payments. Okay, so you will need to do your loan amortization. Now, if you link everything up right, and some of you may have several loans, right? But if you link everything up right, you might be guessing at your loan right now a little bit. And that can happen, okay, because you don't know for sure. You haven't finalized the equipment purchases or something like that. Okay, that's okay, but if you link everything up properly, then if you have to go in and make a change on that loan amortization or your equipment expense, then you'll have some automatic changes taking place on here, okay? And so just make sure you hook that up correctly. And that is simply by, just hitting the equals or the sum, and then go and highlight the first 12 months of the principal portion. If you have more than one amortization, then you hit a plus sign and you do the sum again and you go to the other amortization and you take the first 12 months of that. Okay? And some of you might have 3 or 4 loans. It would not be totally out of the question. Okay? Other current liabilities, I can't imagine. Maybe, somebody has some, but I can't imagine that you guys should really. Bank loan payable, that's your big amount. Right, or amounts. It's the combination. If you want to break them down, that's fine. I don't have any problems with that. You could even do that up here. Current portion of real estate loan, current portion of equipment loan, current portion of, right? You could make 3 of them if you wanted to. That would be fine. Okay. Short-term portion, less short-term portion is just the negative of, and in fact it's already entered in there for you, it's the negative of this number up here. Again, all we're doing is we're taking what our total loan is. Let's say we started at $100,000, but we're going to pay $5,000 in the first year. That's what the principal portion of our first 12 payments are. Okay? then we're going to have a $5,000 up here that becomes a current loan. We have $100,000 of a bank loan minus $5,000 of the short-term portion. So we end up with, at the start of the year anyhow, we end up with the $95,000 in total liabilities. Okay. Notes payable to stockholders, you might have loans other than to a bank. That's fine. If you're going to borrow some money from Uncle Fred, Aunt Martha, okay, that's fine. You can do that. Or to stockholders, that would be to individuals that might be a part of your company, okay, or members. Total liabilities, your net worth or equity then should calculate for you, okay? And it's just the accounting equation, right? Total assets equal liabilities plus shareholders' equity, owner's equity, right? Questions? Okay, you'll all have it done today. I anticipate that you'll make some changes, as you discover things. Again, I'd go through and kind of fill these things out, put in some numbers. If you're unsure of what a total's going to be, highlight it. Just remind yourself to go back then and change that when you get the actual totals and stuff that you can put in there. Okay, let's go on to the monthly income statement. Yep. And it's kind of already got some categories and stuff in here, and some of these are good because you're probably going to use them, and it kind of gives you an idea of what to look at, right? But some of this may vary widely depending on your type of business too, right? Okay. Your sales, that's going to be your estimated sales. And how do you calculate your estimated sales? That's going to be difficult, right? And this is part of it that's going to require a little bit of research, I hope. Okay. For some of you, if there's a similar type of a business, okay, in another town, maybe you can give them a call. How much revenue do you guys generate every year? Give me a rough idea if you could, right? Nothing wrong with that. Most people are willing to share that information. If it's a restaurant, don't call them at noon or don't call them at 6 o'clock, right? Call them at 2:30 in the afternoon when it's probably not too busy, and Martha or whoever will talk to you for a little bit, right? Okay. Nothing wrong with that. Might you call down? Has anybody called Bear Paw Development yet? Is Joe LaPlante still the guy down there? I need to call down there and find out. I'm pretty sure I talked to Joe and he said he was doing something else and somebody else is in that position. I'll try to figure that out. I'm sorry. Sales returns. Okay, and sales discounts. In my mind, I don't think they're showing it here correctly. To me, both of those would be negatives then. They would be, if somebody's returning things to you, then that's going to be, obviously, you're crediting back something to customers or giving them a refund or whatever. So that would show up to me as a negative, and same with some discounts. If you were showing your discounts this way, you may or may not have that. Even in a retail situation, you might not record it that way, and that's fine. Okay, other revenues. You might want to break things down by categories as opposed to having just one big sales number up here. You may want to instead change all these to, sales of widgets, sales of ski boots, sales of bolts and nuts, sales of whatever the case may be, right?
So on ours, would we just do sales of beer and sales of wine, just to keep those two separate?
Probably, but you might do a third one because you're probably going to sell, if you go, growlers, what else?
Okay.
T-shirts, right? You go down to Triple Dog again, you look at things on the wall and stuff, and, mugs and whatever. And you might throw growler. You might just throw all those into one category. That's fine.
Just
Merchandise, yeah. Yep. You might want to break it down. That's okay. You don't know what a growler is? Man, I tell you.
Oh my God. Yes.
And I just highlighted an article from my law class on Friday. It's about a beer made in Iceland, and they actually use whale testicles to make the beer. That was my reaction too. I don't think I even want to try that. And not only are do you know how they are smoked whale testicles? And according to the article, they smoke them with sheep manure. They didn't call it sheep manure. They called it something a little more that I didn't want to repeat. So, It's like a new brew, and the guy said it did have kind of a smoky taste. He said, and kind of okay. And I said, well, I think I'll pass on that one. I'm kind of, the Germans I think have a law that if you're going to sell beer in Germany and call it beer, it has to be made with 4 ingredients and 4 ingredients only: water, hops, malt or your grains, and yeast. And that's what beer should be, in my opinion. If you start adding fruit and stuff like that, anyhow. Okay, cost of goods sold. Do you have a cost of goods sold? Yeah, you might want to expand this too, like you guys. I'll refer to the beer one again, because your beer and wine, beer may have a gross profit of 40%, wine may only be 35%, and your merchandise may be 50%. I don't know, right? So you may want to set that up and have a separate category for each one.
If you're a service, you wouldn't have any of that.
If you're a service, you probably don't have a cost of goods sold. The exception to that would be if you have direct labor that's related to that service. Okay, if you were hiring people and you were basically paying them, you're charging $50 for a horse massage. That's almost a tongue twister. And you're paying them $30, right? You'd have a direct labor cost that would be a cost of goods sold. You probably don't have that, but that's how you'd set that up. Okay. Operating expenses, salary and wages. Do we include your guys' pay in that? It's a good thing we're having this review of business finance stuff. No, you guys don't get paid anything. Sorry. It's tough. That's what you get when you're a business owner, right? Okay, this would be what you would pay any helpers that you might have, if you have any. You may not. Okay, and that's fine. But if you're paying other help, this is where that would go. It does not include what you take out yourself. What you take out yourself will be called an owner's withdrawal, and that'll show up on the cash flow. Okay, and the reason we do that is because when you get all said and done, because you're going to either have, unless you're a Schedule C corporation, okay, subchapter C, I should say, unless you're a subchapter C corporation, which none of you should be probably, okay, you would not pay yourself salary and wages, okay, and the reason for that is that every other entity, right, you as an individual pay taxes on the bottom line here. Okay, so it doesn't really matter what you take out of the company, you're going to pay taxes on the bottom line regardless.
Would that include, we were talking about the contract employees?
Would that include contract employees? You might set up separate category for those, okay? And the reason for that is because you got, when you have salaries and wages, and on the cash flow, it's actually going to show also benefits and those types of things, which should probably be on here too. But if you have contract employees, then you shouldn't have any benefits or anything, right? I mean, that's one of the reasons you have contract employees, is try to stay away from that. So, depreciation, okay. We got to talk about depreciation a little bit, but there's a link on the D2L homepage there for the depreciation that takes you to the website at the IRS. I'm all in favor of doing it the simple way, simple depreciation. Okay, if you want to, and I don't know enough about the depreciation schedules that I can give you good advice, but if you want to talk to somebody that knows more about depreciation schedules than me and set it up that way, that's fine, because there are about 2 or 3 different ways I think that you can calculate depreciation. There's the standard, there's accelerated ACRS, accelerated cost recovery system. There's modified accelerated cost recovery system. That's what they call depreciation. That's the fancy words for depreciation in IRS lingo, is cost recovery. Okay, and what they do is they allow you usually to depreciate more on the front end, and then it goes down a little bit after that. Okay, straight line depreciation's a little bit easier if you have a 5-year a piece of equipment that's 5-year. I do expect you to look that part up. That's what the link will tell you. If your property or equipment's 5 years, then you depreciate over 5 years, right? If it's a $6,000 item, it's $1,200 per year. It's $100 a month, right? Okay, just to use some easy numbers there, right? If it's real estate, you depreciate it over. If it's buildings, I'm sorry, because the actual dirt you don't get to depreciate. But if it's a building or whatever, then you depreciate that out over 28 and a half years or some goofy number like that. Okay, and you just got to do the math and you use a calculator. It's pretty simple, right? Divide 100,000 by 28.5, divide it by 12, and you get your monthly depreciation. Okay, so Straight line's fine. I understand that in the real world, you probably use another type of cost recovery system or depreciation. You're probably going to work with an accountant on that. I would. I mean, I teach business, and I'm not sure I understand the depreciation schedules enough that I'm willing to do that myself. I'd rather pay somebody, I guess. So, okay, office expenses, yeah, whatever. Okay, paper, toner for your printer, whatever the case may be. You'd have a tendency to underestimate that, so think that through pretty well. Rent expense, if you have any. Some of you may, some of you may not.
Why is it increased throughout the year? Like, isn't your rent pretty set?
I would, yeah. I don't know why they have that on this example, so yeah. You can largely ignore. They got the interest down wrong here too, because your interest would always go down, right? You should pay a little less interest every month because you're reducing the principal a little bit. So I wouldn't, yeah, don't pay attention to the numbers necessarily that are on here. In fact, the first thing I would do is probably just go through and delete all those. Travel expenses, you may or may not. Okay. I would call travel expenses those types of things that maybe you do that are outside of your normal business. Okay. If it's within your normal business, I might call it something else. What would I call that? You might just have gas expense. Okay, you might have maintenance expense on your vehicle and some things like that if you actually own the vehicle because you're going to depreciate it and whatnot. If it's owned by the company, okay, if it's a company vehicle, then you would do it that way probably. The travel expense, I'm thinking, yeah, if you got to go to training, that's a travel expense, right? Could be. Or at least the travel to the training would be a travel expense. The training itself would be training expense, obviously. Okay, does that kind of make sense? Okay, if you are not going to own a vehicle for your company, but you need a vehicle, you might rent one from yourself. That can happen. Okay, you can pay yourself for using the vehicle. The company can pay you, right? They'd pay you at, I think the IRS rate's still around 55 cents a mile, something like that. Okay, so then you just try to figure out how many miles you're going to put on, and then you'd put that in as your travel expense, or call it something else, vehicle expense, whatever the case may be. Yeah, that's fine. Vehicle rent, something like that. Maintenance expense, that could be on your equipment, that could be on your building. You may want separate categories for that depending on what all you have. Advertising expense, you can certainly break that down too if you wanted to. Okay, because you might advertise flyers, advertise newspaper, advertise radio, advertise billboard, advertise whatever. Direct, mail, okay, whatever type of advertising you're doing. Others, there might be lots of ideas, and in fact, I think when we look at the cash flow, it gives some other categories too that you might take a look at. So, again, their interest expense obviously is wrong here because interest expense should go down every month unless you're increasing your loan amount outstanding every month, which Garrett might actually, again, because this is a little bit of an oddball structure that he's going to have. But for the most part, your interest expense should decrease then each and every month. And where's that going to come from? Yeah, right from your loan amortization, right? And you have to painstakingly go through, and because on your loan schedule it's vertical and on this it's horizontal, and so you have to painstakingly go through, and you should link it one by one, okay? And again, then if you make a change in your loan amortization and your loan amount, it'll automatically update it on here. So make sure you link those things, okay, properly. Questions about that? Questions about the loan amortization? It's a real simple document, right? I'm just gonna, do I have it up here? Yeah. I'm gonna pop it up just in case folks that are listening on this have any questions or anything. Real simple, you just put in your loan amount, whatever that is. I'm gonna buy a car. Oops, I gotta enable editing first. So I'm gonna buy a car for $25,000. My bank's nice, they're only gonna charge me 5.25% interest. 5 years, yeah. You can tell this is an old program. So I'm going to start, what's today?
14.
So I'll start the middle of February. 2/15/2015. I won't make any extra payments. My payment amount's going to be $474.65 per month, right? And it's broken down here. right? First payment's broken down is principal of $365, interest of $109.38, and it changes each and every month, right? Okay. Questions about that loan amortization or anything? Anybody knows how to do that? Again, you might have separate ones for separate things that you're buying, separate things that you're financing. That would not be unusual. Quickly, we'll take a look at the cash flow. There's two different cash flow statements, I think, on there, and you can use either one. I don't care. I kind of like this one a little better. It's a little cleaner, I think. It's cleaner up above. It gets a little bit awkward down here for whatever reason. So your pre-startup column needs to look exactly like your startup expenses. Okay, you don't have any cash sales before you start, right? You don't have any collection from credit sales, so that's a zero. That's a zero. New equity inflow. What's that?
Your investment.
Your own investment, your personal investment, or your mom or dad that's going to give you $5,000, or maybe have an equity interest in your business. Okay, and then loans received. Bingo. Okay, so the top part's done. It's going to look just exactly like the top part of your startup in terms of the total amount that you have coming in. That's what this needs to equal, right? Total receipts is going to equal your total startup funds, right, from your startup. Okay, payments, just exactly. You take these right from your startup sheet. Some of the names and categories over here might be a little different. Yeah, you can change these. That's fine. I don't have any problems with that. Okay, change them or make it fit. Okay, so that your total payments are the total that's going out, just like on your sources and uses or startup. And then your opening cash balance down here becomes the key number, and that should be your working capital, again, that's on your startup, or your cash balance on your opening day balance sheet. Same thing, right? Okay, that's the test right there. Don't force that number in there. Make sure you fill all this out right, and then that's your test to make sure that you got the numbers in there right, because then that number should be the same as your working capital or your cash on your open day balance sheet. And away you go. Okay. What are the things that are different on the cash flow versus the income statement? Because most of the stuff is the same. Most of the stuff is the same. You guys think of what might be different? Remember?
Is it your owner's drawing?
Your owner's draw. Owner's withdrawal is one of them. Absolutely.
And depreciation?
Depreciation. You'll have depreciation on your income statement that you don't have on your cash flow. You'll have an owner's draw on your cash flow that you don't have on your income statement. Okay. Any others? You might have some prepaid items like that prepaid insurance or your training or something that might end up on your income statement. Your prepaid insurance, because you're kind of writing that off as you use it. Okay. That won't be on the cash flow because you have to pay for that up front. Okay. Your cost of goods sold versus your purchases might differ. And in this case, we got a pretty good example if you guys are doing the brewery wine thing, right? Okay, because you're going to have to buy your stuff a month or two ahead of time to make your beer and wine, and then you're going to sell it later, right? But your cost of goods sold, you actually take that expense when you sell the item. And so you're going to have purchases on your cash flow a month or two ahead of time, and then cost of goods sold, and so it's you're going to have a little bit of an offset there. A lot of us, I tell people like that, typically doing a coffee shop or something, right? If you're doing a coffee shop, what happens? You get about as much inventory in each month as you sell, and so that becomes a pretty much a regular replacement type of a thing, and so you could put them down as the same, and it wouldn't be a big deal. But in your guys' case, it's going to be a little different. Okay, because it should be a little different, because you're going to have to stock some stuff up. And
but then, what if it changes, from month to month? Say you have it in cash flow or whatever, you have your set amount, you just go in and change it.
what happens if it changes?
Yeah, your inventory.
It can, certainly. In real life, you mean?
Yeah,
Yeah.
just go in
Well, that's why we do business plans, because then you go back and you check and you see, if you estimated that you were going to need $2,000 worth of inventory and you need $3,000, that's a good thing, right? But you might have to go back and make some adjustments then and whatnot. And the opposite is true as well. And you might have seasons too, okay? John maybe is going to end up with some seasons there, right? Okay. Certainly in his sales, I don't know with your cost of goods sold and stuff, but you're going to be, yeah, I don't know. We'll have to see how you realize your cost of goods sold. I don't know if you're going to have to pay for the rough lumber or what. We'll have to see. So, did I kind of answer your question, Kayla, or did I miss it?
Yeah, no,
Okay.
you answered it.
Okay. A ski place, right? You're gonna be buying stuff in August. If you were selling it, you guys are talking about renting it, but if you were selling it, you'd have to buy it in August, and then you're going to sell it in December, right? And so you end up with some seasonal types of things that can happen. Okay. Other than that, what am I missing? Seems like there's one other that I'm missing that's on one and not on the other. If there is, we'll probably. The principal portion of your payments will show up on here as well, which is right here. Loan repayments, principal portion. Okay. But also on here is your interest portion. So on the cash flow, you have both the principal and interest, because when you write out your check for your vehicle for $474.65, I have to write that out every month, right? So my cash flow is going down that much, but I only get to deduct the portion that goes to interest, and so that's the only part that shows up on my income statement. Okay? Clear? Okay, I've used a good half hour. That's enough, so I'll stop so that you guys can go to work on that, and I can come around and kind of check on you, see how you're doing, and feel free to ask any questions that are more individually applicable.